Thank you for the warm welcome. A very good evening to all the participants. First of all, thank you for attending the session and giving us the space to speak. We are highly obliged and happy to have you all in such a big number. In fact, when I see the list of participants, I see very common names, either personally known or have attended the earlier sessions, is what I understand, like Ankit and Bhaskarji and Nitinji and Santoshji and so many people. I can just see the names. I'm very happy internally to see such names again. Uh, so thank you for all attending the session, and I hope we bring some more clarity and uh, some homework for you all to evaluate on this aspect. I'm sure this topic is critical for you, and hence you all are attending. Um, Before we even start, again on the Q&A side, would love to make it interactive, similar to the last session that we did. Please drop in your question in the Q&A or the chat box, and we'll be happy to answer those questions during the session or at the end. We have a 10-minute plan of Q&A at the end, any which ways. So do drop in your questions. Also, if you can drop in your questions along with your email IDs, it will be preferable so that we can answer it over an email to you if we are not able to answer due to lack of clarity of the question, lack of clarity of the law, or lack of time. So we'll be happy to answer you all over an email, and we can interact. With that backdrop, let me start the session. Uh, um, so corporate guarantee, why are we talking on this topic? What is corporate guarantee is what I would speak first. Would also lay down the table of contents before I hand it over to my colleagues. Corporate guarantee as a subject is where I will speak that first. Let's dive into what is guarantee. Guarantee, again, I will use very layman language, not as per the Indian Contract Act or any other act as far as this discussion is concerned. A guarantee is a promise to do something if something occurs. So let's say today you buy a television and you go to the store and you ask them what is the guarantee. And by the way, warranty and guarantee are interchangeably used. In my view, warranty is a subset of guarantee. It's more legal, it's more in written, etc. But let's use the guarantee as a word. So if you buy a television today and the television manufacturer says that I'm guaranteeing you that if anything happens on the television, if anything happens to the television in 1 year, it will be replaced. And if it happens between 2 to 3 years, we will repair it free of cost. What happened in this transaction is the television owner guaranteed you the performance of the television for first year as well as second and third year. So the transaction happened between you and the television owner, where you purchased the television and got the guarantee from him. Correct? This is nothing but a guarantee. Now, let's say you would have also heard of bank guarantee as a concept. What is the bank guarantee? Let's say, again, in an example, I want to import goods and I want to pay custom duty, but because of some reasons, the assessment is happening provisionally. Let's say they are related party and hence it is provisionally being assessed. Final assessment is pending. What will happen? You will seek approval from the custom officers that I want to import these goods, and final assessment. During the final assessment, if there is any liability further to be paid, I will be happy to pay it. What will custom officers say? You please provide a bank guarantee to me that if there is any liability, you will pay, and if you don't pay, the bank will pay it to us. So you go to your bank, you ask them to give you a bank guarantee in the name of the custom department, and ultimately you submit that bank guarantee and the goods are removed. In this transaction, bank provided the guarantee to the custom department where you would have your bank account. So this is a bank guarantee, where bank is the provider, you are the beneficiary, or custom officers are the beneficiary, and you are the person importing goods. So that is a bank guarantee, correct? Now let's go to the personal guarantee. I'm giving some examples for you to reach out to the space where we are going to speak on corporate guarantee. let's say now there is a personal guarantee. You as a company, the company wants to take a loan from a bank. You don't have money or the liquidity, and hence you want a loan, correct? In that situation, what will the bank do? Bank will say that I'm happy to provide you a loan subject to the collateral that you give me. Again, unfortunately, the company does not have a collateral as well. In that space, probably a director of the company who is very clear about the performance of the company and the future of the company will say, okay, I will personally give guarantee on this loan. Okay, so this is the personal guarantee where a director is guaranteeing to the bank that he will repay the loan if it goes bad, which ultimately the bank will provide the loan to the company. So these are the bank guarantee, performance guarantee, or a personal guarantee, which we spoke about. But the twist comes in when there is corporate guarantee, and that is where entire taxability or discussions are happening. And by the way, this corporate guarantee concept is very close to my heart because this litigation is happening for more than almost 9 years now, and I was part of this litigation, and the the fate has actually been received by the Supreme Court very recently, and hence we thought it is very important for all of us to talk about it on what Supreme Court has said and why it is relevant, and also why it is not relevant in this era. So corporate guarantee is a space where there are two companies involved. One company is in need of, let's say, a bank loan. The other company is either a holding company or a subsidiary company or a group company who is ready to give a corporate guarantee to the bank, saying that if my group company or my subsidiary or my holding company is not going to repay it, then I will be repaying it because of whatever reasons. So in this situation, we see three parties: a bank giving a loan to a, let's say, subsidiary, and a holding company giving a corporate guarantee in case where the subsidiary is not able to repay. So there are three parties again involved here: surety, principal, debtor, and a creditor, which we will be speaking about. But ultimately, the beneficiary of the transaction is one person and the provider is one person. So we will be speaking more about it. And why it is more relevant from taxability perspective is because we will see that in most of the space of corporate guarantee, there is no consideration. Because one company will give a guarantee because it's a group company or a holding a subsidiary, and the other company will get the transactions in place. So that is the crux of the matter, that there is no consideration involved. So how do we really value the transaction if it is taxable? So with that backdrop, friends, we are going to speak on the following aspects. We will answer most of the questions that you may be having, which would include what is corporate guarantee. Second, what are the direct tax implications on providing or receiving a corporate guarantee? Third, what are the indirect tax implications under service tax law, which we will briefly talk because the Supreme Court has recently pronounced its judgment. What does Supreme Court say? And also we will highlight on why it is not relevant from GST era perspective. And obviously then we'll talk about more about GST perspective of what is, whether it is taxable or not. And if it is taxable, how do we value it? So with that backdrop, we will run the show. The table of contents are in front of you. First, we will talk about the three topics of the law and the GST implication, which Sunil will be taking up. And then we'll hand it over to Sanket on the transfer pricing and direct tax perspective. With that backdrop, Sunil, would you mind taking up the few slides, and then we'll hand it over to Sanket.
Sure, Jigar. Thank you. Thank for setting the backdrop of today's deliberation. Thank you, Komal, for introducing all of us. And thanks to all the participants for joining in such a large number. So this topic, if we'll start. So Jigar has already explained you the transaction background. Just quickly, noting it down. There is a holding company and there is a subsidiary company. Subsidiary company has applied for a loan to a bank and obtained a guarantee from the holding company, and accordingly process the loan to the subsidiary company. The question comes here is that whether the subsidiary has provided any sort of services to its holding company or not. This is the subject matter of today's discussion. So before deep diving to the GST, let us quickly understand the Contract Act, how the Contract Act basically deals with the contract of guarantee. if we refer the provisions under the Indian Contract Act, the Indian Contract Act provides a specific provisions relating to the guarantee transaction. Section 126 of the Indian Contract Act defines what is the meaning of guarantee. It says a contract of guarantee is a contract to perform the promise or discharge the liability of third person in case of his default. So there is a third person who is in our case is S Limited. If he defaults, then the person who is giving a guarantee would be liable to pay that amount to the person, to some other person who is not being covered in this definition, right? The section basically, provides three types of parties. One is surety, that is the person who gives the guarantee. There is a principal debtor, person in respect of whom default guarantee is given. In our case, it is S Limited, and surety is H Limited. And the creditor, the person to whom guarantee is given. In our case, it is bank. Now, if we see the Indian Contract Act, to make an agreement enforceable before a court of law, the contract should have some certain essentials. And these essentials for a valid contract is being provided under Section 10 of the Indian Contract Act. One of the essential to a valid contract is a consideration, meaning thereby that to make an agreement enforceable before court of law, consideration needs to be there. So the question in front of us now is that when bank is receiving a guarantee from H Limited, that is holding company, what in turn it's providing to the holding company? Because if there is no consideration, then bank would not be able to enforce this contract before the court of law. And therefore consideration needs to be determined in the contract of guarantee. So this particular issue is being, this particular issue answered by Section 127 of the Contract Act, which provides that anything done or promise made for the benefit of the principal debtor would be a sufficient consideration for the surety for giving the contract. What does it mean? It means that the benefit which the bank is given to the subsidiary company, that would be a sufficient consideration for the holding company. And since there is a consideration between the holding company and bank, therefore this contract is an enforceable contract before the court of law. Right. This is an important perspective because it's an exclusive contract. It's a different contract than a transaction between a holding and subsidiary company. The holding company is something providing a benefit to the subsidiary that is subject to GST taxability. But from the Contract Act perspective, this contract of guarantee is altogether a different contract. Moving forward, if you see the regulatory aspect of it, the Companies Act basically provides two sections, Section 185 and Section 186. Section 185 of the Companies Act primarily provides about the loan, guarantee, security, investments, etc. to directors or to a person to whom directors are interested. Now, this expression persons to whom directors are interested is quite very wide. It includes the corporates also where directors are interested, right? If you want to do an investment or to provide guarantee in respect of these person, you have to have certain compliances. For example, you have to pass a special resolution. The condition is that these funds, etc., must be used for principal business activities. But the interesting part of this particular provision is that this compliance requirement is not there for the wholly owned subsidiary company, right? Provided the funds are used for primarily business purposes. Similarly, Section 186 talks about the intercompany loans. So if you are giving the loan, guarantee, or investment in respect of or to the other company, then Section 186 would play its role. It provides certain types of approval. You have to have a unanimous board approval every time whenever you are doing the guarantee investment transaction. You have to have special resolution in certain specified cases. Approval from financial institution is needed in certain cases, etc. And there are certain other conditions needs to be satisfied. But what is interesting in this section also is that this section again provides that if you are giving the guarantee, loan, investment, etc. to your wholly owned subsidiary, then these approvals or conditions are not required to be complied with. So what we can gather or what we can understand from this Companies Act provision is that the Companies Act, seems to treat this subsidiary, the wholly owned subsidiary, as an extending arm of the corporate, the holding company, right? This is something which is, coming out of these two provisions, because they're not providing any sort of prior approval for giving loan guarantee, etc., to your wholly owned subsidiaries. Now, as Jigar has, explained that recently Supreme Court has held that the corporate guarantees under service tax are not exigible to tax if there is no consideration. So we have, if you see the provisions of the service tax law, the levy provision under the service tax law used to provide that the service tax would be levied on the services provided by one person to another person for a consideration. So the consideration was a prerequisite to tax any transaction. And Apex Court, in the case of Ilvis Financial Services, held that since the corporate guarantee, when provided by the holding company to its subsidiary, as there is no consideration between these parties, this cannot be exigible to service tax. The tribunal's judgment was, basically upheld by the Supreme Court. The question comes in front of us that whether this service tax judgment of Supreme Court is relevant under GST or not. I would say majorly it would not have any implications. Why so? We'll be deliberating the GST provision, in the subsequent slides. But we all know that in respect of related party transaction, the consideration is not a precondition for taxability, right? Hence, placing reliance on the service judgment of Supreme Court, or maybe the tribunal's judgment, which was there indeed before this Supreme Court judgment, may not be useful for us. But if you are giving the guarantees, etc., to some unrelated person for which you are not charging the consideration, this judgment can very well be useful for you. Now, as far as the service tax litigations are concerned, you can, what would be the way forward? The way forward would be that you should revisit the ground of litigation. Your matter may be pending before the appellate authority or maybe tribunal level. You should revisit the grounds of litigation, and appropriate correspondence should be done with the appropriate authority using this judgment. And if you have already paid the pre-deposit, etc., then you can also apply for the refunds post closure of your case. Now let us understand the GST provisions. We all know that the subject matter of taxation under GST is supply, which has been defined to include all forms of supply such as sale, exchange, barter, everything is covered. But it should be, as a general rule, it should be for a consideration, and it should be in the course or furtherance of business. If these conditions are satisfied, then a supply is exigible to GST. Now we have schedule 1 where there are certain transactions listed in the law which provides that if in these cases the consideration is not there, then still the transaction is taxable. And one of the clauses that if there is a supply of goods or services between related persons in the course of furtherance of business, then even if there is no consideration, the supply between these persons would be exigible to GST. It's very important that the law has carved out the condition of consideration, but it has not carved out the condition in the course of furtherance of business. So supply between related persons which are in the course of furtherance of business may or may not be for consideration is exigible to GST. Now, as we have seen, the subject matter of taxation under GST is either supply of goods or supply of services. So if a transaction whereby you are supplying something which is not qualifying as a goods nor as a services, then it cannot be brought to tax, right? So therefore it becomes imperative for us to really understand what is the meaning of goods and what is the meaning of services. If you see the definition of goods under the Indian GST law, it provides that goods means every kind of movable property. It excludes from its scope monies and securities, but includes actionable claim. Thus, we can say goods means movable property and includes actionable claim within its scope. But if we read Schedule 3, Schedule 3 provides or enlists certain transactions which are neither treated as supply of goods nor supply of services. It provides that actionable claim other than lottery, betting, and gambling, it would not be treated as supply of goods nor supply of services. So reading the definition of goods and the transaction and schedule 3, we can say that good means movable property. It includes the supply of lottery, betting, and gambling. And apart from this, anything other than this, which is in the nature of actionable claim, would not come under the purview of GST law and would not be exigible to GST. Right. Services has been defined as anything other than goods. Now, actionable claim will be deliberating, at length when we analyzing the implication of corporate guarantee. So therefore, this definition is important. So let us have a quick discussion about this definition. Actionable claim per se has not been defined under the GST law. It borrows the definition from the Transfer of Properties Act. There, actionable claim has been defined as a claim to any debt. It's a very important definition, and I would want everyone to be focused. It says actionable claim means a claim to any debt, and it should be other than debt secured by mortgage of immovable property or by hypothecation or pledge of a movable property. Right. So if you see the first limb of the definition, it means actionable claim means claim which are in the nature of unsecured debt, because secured debts, be it for the movable property or immovable property, it excludes from its scope. Right. The second limb says actionable claim means a claim to any beneficial interest in the movable property not in the possession of claimant, either actual or constructive. So there is a beneficial interest in a particular movable property which is not in your possession, either actual or constructive, which the civil court recognizes as a affording ground for relief. And this debt or beneficial interest can be existent, accrued, conditional, or contingent. It's very important. So if you'll see, the second limb of definition says claim to any beneficial interest in movable property which is not in your possession, either actual or constructive, and this claim of debt or the beneficial interest can be existent, accruing, conditional, contingent. Right. Just remember this definition. Will be deliberating in context of corporate guarantee in the upcoming slides. Right. The valuation provisions, if we see GST law, the GST law basically, requires to pay tax on the consideration that is a transaction value. This is the general rule. However, in respect of related party transactions, the law disregards the transaction value. And if you read the customs law and the GST law, there is a difference. Under customs law, if you are able to prove that the transaction between related parties is genuine, then that is acceptable. But GST law said that we will not see the transaction value. You have to have determined the value using the valuation provisions given under the CGST, right? So CGST rules provides primarily the 4 methods. The first method is the open market value. So in respect of transactions between related persons, you would require to value your supply using the valuation provisions given under the CGST rule, and the first method is open market value. Now the concept of open market value is that assume for a time that a transaction is happening between unrelated person. Had the transaction been happened between unrelated person, what could be the price for which the supplier would be charging from the recipient? That would be treated as an open market value, and that would be subject to GST in respect of transactions entered between the related persons. Interestingly, the second proviso of this particular rule, open market value rule 28, it provides that if you have declared anything on the invoice, the value which you have declared on the invoice, if the recipient is entitled to avail the full input tax credit of it, then whatever value you are declaring on your invoice, that would be treated as an open market value. It's very important, right? So if, to summarize, just if the credit is available to the recipient, then whatever value you are declaring in your invoice, that would be treated as the open market value. This is a very important provision, because this will, resolve so many litigations on its own if the credit is available to the recipient. If you're not able to determine the valuation using the OMV concept, then there is a concept of value of value of supply of like kind and quality. If you're not able to determine with this methodology, then we have a cost plus method that 110% of your cost of services would be treated as the value of supply. And the last, we have a reasonable method. A reasonable means which is consistent with the valuation provisions needs to be applied if you're not able to compute the value using any of these methods. Now let us have some quick questions. Then we'll be discussing the taxability and valuation in detail. My first point is whether extending guarantee is a supply of services by holding or not. Is there any benefit extended by the holding company to a subsidiary or not? Can we argue that the activity of the holding company's shareholders function? We'll be deliberating this concept in length when we'll be discussing about the income tax, treatment under income tax. See, the primary objective, if you'll see, academically, why the holding company is providing or extending the guarantee to subsidiary. The intent is to protect its own investments, etc. Right, and that is why it is a shareholders function. The subsidiary is primarily an extended arm if we'll talk about the wholly owned subsidiary company. So the question is, can we argue that this activity is a shareholders function of the holding company or not? Interestingly, as we have seen in the taxability provision, that to tax a transaction between related person, the condition is that the supply needs to be in the course of furtherance of business. So can I argue that the guarantee which has been issued for subsidiary, it is not in the course of furtherance of my business? The funds, etc., which would be released would be used by subsidiary for its business. So this activity per se is not in the course of furtherance of my business. The last is, can I argue that the activity performed for the subsidiary is a supply of actionable claim and therefore it would be out of the purview of GST? In context of valuation, if you take a view that okay, the tax, there is a supply and tax needs to be there, then there are questions relating to the valuation also. First is, do we have an open market value available for these services or not? Do we have a like kind and quality of service in this case or not? Can we take the reference of bank guarantee as a base to determine the value of our corporate guarantee? Can we take references of some other valuation provisions, for example, safe harbor rules, where 1% has been prescribed as a rule? We'll be discussing detail at length in income tax part. But can we take reference of these types of provisions to value the transaction under the GST law? These are the questions that needs to be answered. First of all, actionable claim. So we have seen the definition into two parts. The first part talks about the unsecured debts, which can be existence, accrual, conditional, or contingent. So the corporate guarantee, the guarantee contract, is primarily a contingent contract, whereby if the subsidiary company is unable to pay the amount to the bank, then the bank would exercise its rights under the contract of guarantee contract, and it will enforce the contract against the holding company. And therefore, it is a contingent debt. And that is why you report this transaction in your notes to accounts also as a contingent liability, right? So it's an unsecured contingent debt. As a prima facie view, you can call it as an actionable claim. But the question is, can I say that there is a supply of actionable claim by holding company to the bank? Because if it's a supply of actionable claim to bank, then it would not be subject to GST, right? So if we break this transaction, then what we can say that the holding company is providing an assurance to bank that, see, if tomorrow something happens, I am there, right? This assurance services has given rise to an actionable claim. So I have per se not supplied the actionable claim. This contract has created a product called as actionable claim for bank, which tomorrow if bank is supplying to someone else, it can be called a supply of actionable claim, right? This is a one view. And therefore, with this view, what we can say is that the actionable claim which has accrued due to performance of services should not be equated with the supply of an actionable claim, right? This is the one view. But if we see, there is a famous judgment of Constitution Bench of Supreme Court in case of Sunrise Associates dealing with the taxability of lottery, etc. There, the Supreme Court had dealt this issue in detail, the definition of actionable claim. The question was whether the dealer who is selling the lottery to the participants, is it a sale of goods or is it a supply of or sale of actionable claim? If we read the VAT laws, etc., there also the definition of goods used to exclude actionable claim from its scope, right? Similar to GST. The question before the Constitution Bench was whether the sale of tickets, lottery tickets, is it a sale of goods or sale of actionable claim? Now, this question is risen because three-judge bench of Supreme Court earlier had that in a lottery contract, there are two transactions. There are two rights. One is right to participate in the lottery contract for which you are purchasing a ticket. And second is the contingent claim which can come in future. That is the winning prize. So three judgments said that second part of the transaction is actionable claim. No doubt about it. Because it is an unsecured claim against the sponsors towards the winner, right? Okay. But the three judge bench said that the first transaction is a sale of ticket, a sale of goods. When the matter reached to the Constitution Bench, the Constitution Bench said that we should not bifurcate this contract into two different activities, because the intent of the contract is primarily to win a prize. You're purchasing a ticket to win a prize. You're not purchasing a ticket to have a right of ticket and then have a claim in future. They are saying it is illogical to bifurcate the lottery contract into two separate transactions. The Constitution Bench held that the sale of ticket by the dealer to the participant is a sale of actionable claim, and therefore it would be out of the VAT laws. Taking the views of the Supreme Court judgment, the question that comes here is that can we argue that the giving a corporate guarantee by H Limited to bank, it is nothing but a supply of an actionable claim? Because why should we bifurcate the contract into first there is a service which has given a rise to this actionable claim, which is a claim for the bank? Again, it needs to be seen. It is to be tested before the court of law. But this view is also, very well possible. Moving forward, shareholder functions. We'll be deliberating conceptuality in detail in the income tax part. But if we see the income tax judgment, we have few positive judgments which says that the activity of the holding company is more of a shareholder function and it cannot be brought to tax, because the commercial prudence is to protect the investment interest and not to earn any sort of commission. And specifically after 2012, if I'm not wrong, the income tax law was amended to include the guaranteed transaction within the scope of international transaction. And also we have OECD guidelines on financial transaction in 2017, which primarily explains and recognizes the concept of corporate guarantee. They say that it is some sort of income in specified scenarios. Sorry. Moving forward. The another important point, as I just highlight you, that whether this transaction in the course or furtherance of business, this part specifically we'll see, because what we are seeing, the practice what we are following practice, this particular area has not been touched upon by many of us. That whether the extending guarantee etc. by holding company to subsidiaries, it is in the course of furtherance of business of holding or not, because directly indirectly it is not impacting my business operations performance or profitability. It is just that there is a capital appreciation. If subsidiary is doing well, at tomorrow we would be having a better capital or capital appreciation. So the question is whether just there is a because there is just a capital appreciation, can it be called as or can it be covered within the scope of the expression that yes, there was a intent to supply in the course of furtherance of business. This is something again needs to be tested. Now, if you conclude that there is a supply and it is subject to tax, then there are certain issues relating to the valuation also. First is, do we have an open market value for these services? I would say no, because you are not dealing with any of the unrelated parties, and therefore you cannot have a the price otherwise available if the parties are not related. So therefore, open market value of corporate guarantees given by the holding to subsidiary without consideration may not be ascertainable. Right. Provided if your recipient is entitled for the credit, then in that case, whatever value you are declaring, that will become an open market value. But if the parties are, the recipient is dealing in some exempt activities or credit is not available to them, in that case, there would be a challenge because you would not be having an open market value. Like kind or quality. So we don't have anything similar to, the services that we are providing in our business. So therefore, there would be no similar or like service available to us. The question is, can we take reference of bank guarantee? This is something which is already settled that reference of bank guarantee cannot be taken to determine the value of the corporate guarantee, because bank issues the corporate guarantees after analyzing certain parameters such as the guarantee tenure, credit rating, what is the relationship with you be having with the bank, etc. Right, and we have also provided certain judgments where there it has been clearly provided that the bank guarantee cannot be taken as a reference to value the corporate guarantee. 110% of the cost. So again, in entering the contract with the bank, you would be having a very minimal cost. The cost relating to the agreement, stamp paper, etc. So there is a very minimal cost. So primarily the direct cost is not there. But as I said you that bank gives the bank takes or accepts the corporate guarantee after analyzing the various parameters such as what is your goodwill, what is your worth, what is your net worth or debt equity ratio, etc. Based on these parameters, they accept the guarantee of some holding company. The question is this cost is really determinable for these factors? The goodwill which you have developed over the period of time, the brand value which you have developed over the period of time, is this cost really determinable? Because you have to apply 110% of the cost, and the cost relating to this cannot be computed. If you recall the famous judgment of the income tax law, BC Srivastava Sethi, the question was whether one can determine the cost of acquisition of goodwill, cost of creation of goodwill. There, Supreme Court said that it is not determinable. After that, the income tax law was amended to provide specifically that the value for goodwill would be treated as nil, right? So the valuation of these factors cannot be determinable. And last method we have is the residual method, which says you have to apply the valuation principles which are there in the section 15 and overall provisions to determine the value if you're not able to determine with any of these specific methods. So, the question is whether this particular rule, the residual rule, is it vague or arbitrary, because you're not able to compute the value with any of the methods that we have discussed in the previous slide as well as this slide. And effectively, the question is, can we argue, since there is no effective machinery provision available in the law, therefore the levy itself fails? Because as far as the tax laws are concerned, there are 4 constituents of any levy. That is a subject matter of taxation, which is in our case is supply. Second is there needs to be a rate of tax, which the legislature has to decide, which in our case is either supplier under forward charge or recipient, and in certain circumstances, e-commerce operator. And third, the rate which is there, and fourth is valuation. If any of these constituents are not available in the law, the levy itself gets a failed. So as far as this issue is concerned, here we are not able to determine the value, and machinery provisions are not helping us to determine the value. So the question is, can we argue that since machinery provision is getting failed, therefore I'm not supposed to pay any sort of tax because levy itself gets failed? So these are the issues relating to domestic transactions. When it comes to a transaction whereby an Indian company is providing corporate guarantee in respect of the foreign subsidiary, there is an additional issue apart from the taxability and valuation. If we see the definition of export of services under GST, it basically provides 5 conditions to be satisfied to qualify a transaction as an export of services. One is that the exporter should be in India, the recipient should be outside India. You should realize the consideration in convertible foreign exchange. In certain specified cases, you can also realize in INR also. Fourth is that you should not be a mere establishment of an entity. And the fifth is place of supply should be outside India. Once these conditions are satisfied, the transaction would be treated as export of services. As far as the transaction of corporate guarantee is concerned, where the consideration is not there, the question is, do I need to pay the GST on this transaction because I'm not realizing the consideration in this case? So I'm not satisfying the condition of export of services. This is the question. So in our view, a view can be taken that since the law itself in Schedule 1 says that where there is no consideration, tax would be levied. So law itself recognizes that there is no consideration. Thus, the definition of export of services, the condition relating to the realization of foreign currency or the consideration per se, is deemed to be getting satisfied because that condition per se is not applicable on me because law itself is recognizing, right? And if we see the jurisprudence relating to this particular concept, which I just explained to you, the courts have held that if you're claiming a particular exemption and if there are certain conditions relating to that exemption, if few of the condition or any of the condition is practically impossible to be satisfied, then it would be treated as deemed to be satisfied. There are good number of judgments available. The point is whether we can take the argument or this jurisprudence ratio while saying that the condition relating to realization of foreign currency would deem to be satisfied because there would be no consideration in this case, right? And we can also take the ratio of these legal maxims that law cannot compel me to do something which is impossible because in our contract there is no consideration. Now you can tell me to have a consideration. Second is that if there is a disability that makes impossible, then that alleged disobedience of law is excused, right? So you can take one can take the reference of this also in concluding the view relating to the guarantees provided to the foreign subsidiaries. Interestingly, if we see the proviso to Rule 37, so we have a provision that if you are claiming the input tax credit, then you have to pay the amount to the supplier within 180 days. And simultaneously, we have a valuation provision under Section 15(2) Clause B. It says that something which is required to be incurred by the supplier, if it is incurred by the recipient contractually, then it is to be added. Since recipient has already incurred, so he is not going to pay to the supplier. The question was whether we can claim the credit on it because I'm not going to pay. So the proviso of Rule 37 says that in that case, it would be deemed that you have already paid the amount, right? But the similar exception for export of services are not there under the law, right? So as far as the corporate guarantees given by Indian company to the foreign subsidiaries, this issue is again litigative, and in this regard, appropriate position should be taken. So with this, I am handing over to Jigar to provide his thoughtful points on this issue. Jigar, please.
Yes, Nick. Thank you. All right. So let me just try to summarize, friends, on what all we heard till now. First, we heard that Apex Court has passed a recent judgment in the case of Edelweiss, where they said that uh, service tax will not be liable to be paid in case of corporate guarantees. And the moot reason is that there was no consideration. Mind you, even in the service tax law, there was a provision which mentioned that in case of associate enterprises, um, there is no actual flow of money, the taxability would incur. But it very categorically mentioned that the amount debited or credited in the books of account will be liable to be taxed. So, that perspective is also to be remembered, that in case of service tax regime, if you have actually debited an account or credited an account in the associate enterprise or the related party transaction because of corporate guarantee, then again it will get hit, and the Supreme Court case will not help you to rescue as far as service tax provisions are concerned. Um, for those participants who have paid service tax uh, on corporate guarantee, a window has now opened up, because due to a decree or a law or an order, if there is anything which comes up, you may go ahead and claim refund of the amount which is already paid, or those who are under litigation can file a letter and submit it to the authorities. The Supreme Court, which is a law of land, has pronounced its judgment, and hence all the pre-deposits which are paid should be refunded, and the matter should not be litigated any further. So that is on the service tax space. And then Sunil explained why it will not be relevant from GST perspective. Uh, Again, why it is not relevant, because while the supply definition very categorically says that it should be for a consideration, the Schedule 1 under GST law says that if the transaction is between related party, even without consideration, it will become taxable. So because of the Schedule 1 and the related party definition, this case law or the Supreme Court case should not be relevant as far as GST is concerned. Then we discussed about the taxability of the corporate guarantee itself. We spoke about what is corporate guarantee, and the taxability are basically bifurcated into 2 or 3 important pointers. Whether one, it is an actionable claim or not. Very frankly, it is not tested under the law. Both views are prevalent, but there is a difference between a supply of actionable claim and actionable claim itself. And that's broadly our view, that it may not fit exactly in the actionable claim definition, but there is a view and there is a possibility to litigate on that space as well, because actionable claim is outside the GST taxability net. Now, considering it may not be actionable claim and it is taxable, the next point of discussion was, what will be the value? Because at the end of the day, you're saying that there is no consideration or no value attached to the entire transaction. As for the valuation rules, open market value would be the first point. But again, I don't think so. We can have a open market value attached to an activity where you can directly allocate a value to the corporate guarantee that one company is providing to another. So, for example, if one holding company is providing to another subsidiary, and the value could be 10% of the guarantee, you cannot say that's an open market value, because that could be their terms and conditions. Similarly, bank guarantee cannot be an open market value, because bank guarantee would have its own ways and means to provide a bank guarantee and a determining factor to attain to a value mechanism. Typically, in fact, we've seen the service tax notices being issued, and they have allocated in the notices itself that they will attach a bank guarantee valuation. And very interestingly, they have also, the department has also said that the bank guarantee would be bifurcated into 3 types of bank guarantee. One would be a public bank, public sector bank. Second would be private, and third would be cooperative banks. And when all these 3 banks are providing XYZ percentage of the bank guarantee, what ideally one should charge as a corporate guarantee? They have come out with their own valuation rules as such. So what will be the value is the determining factor, because open market value, and this is not running well. Even the cost, as Sunil was saying, 110% of the cost will not run it well, because we don't know the cost of providing the corporate guarantee. To navigate more on valuation, we have the income tax and regulatory perspective, which will be run by Sanket. And once that is done, probably we'll have much better answer on if we have to attach a value, what do we do about it? Because we have to go beyond GST now and try to find answers from income tax and regulatory perspective, because transfer pricing regulations also are very relevant to it. So I hand it over to Sanket for helping us on valuation, and we'll come back again to conclude on on all the open points. And I'm more than happy to see multiple questions running up. So we will allocate 10 minutes for sure, and if required, a little more. But happy to have more questions. I have already 19 questions in front of me, and let's see where it heads. Sanket.
Sure. Thank you, Jigar, and Sunil as well, for laying down the context. So just before we discuss on the shareholders' activities, wherein Sunil has already given a brief overview of what constitutes a shareholders' activity. Let me just give spare half a minute on discussing what are intra-group services. So intra-group services, basically can be bifurcated into two buckets. One, where tangible benefits accrue to group companies, and where they are even willing to pay for such services, which would be group policy functions, HR, property services, technology transfer, tangibles, etc. The other category of intra-group services would be the ones.
Sanket, I'm so sorry. I got a comment. The volume is not correct. If you can just hold your mic a little closer to your space so that we can hear you well.
Hello, is it
Yeah,
better?
that's much better.
Yeah. Okay. See, the other category of intra-group services are the ones which are performed typically by the parent company or a regional holding company on account of its ownership interest. These services, activities, as we may call it, may not specifically be needed or demanded by the group companies, but they are undertaken for the purpose of safeguarding its ownership interest or for furtherance of its business by the regional holdco or the parent entity. Such category of services, activities are referred in Chapter 7 of OECD's TP guidelines as shareholders' activities. Sunil, if we can just flash the. Yeah. So this is what we were discussing on the shareholders' activities. Now, there is no cross charge of cost pertaining to these activities, and these activities could be in the range of, say, financial reporting functions, corporate governance, if the parent entity is raising funds for the purpose of acquisitions, etc. Question is, I mean, in the context of the topic that we are discussing, whether, say, issuance of a corporate guarantee would tantamount to a shareholder activity. Consequently, the impact would be whether it would be an international transaction as has been defined under Section 92B of the Income Tax Act, and would therefore invite transfer pricing compliances. Now, if we read the definition of international transaction under Section 92B, so if you can flash the next. So international transaction is a transaction between two or more associated enterprises, either or both of whom are non-residents, in the nature of purchase, sale, lease of tangible or intangible property, or provision of services, or lending or borrowing money, or any other transaction having a bearing on the profits. The other part is not relevant, but the key aspect is, a transaction which has a bearing on the profits. There was an explanation also which has been introduced by Finance Act 2012, and this is very important because this explanation as such had a retrospective effect from 1st of April 2002. And Part C of this explanation reads, as international transaction includes capital financing, including any type of long-term or short-term borrowing, lending, or guarantee. So guarantee as such has been brought within the definition of an international transaction by virtue of this amendment. The question is, how do we read this explanation which has been introduced in the context of the meaning of international transaction which has been defined under 92B? In Cadila Healthcare's case, the ITAT has specifically held that lending or guarantee would fall within the residuary clause, which is other transactions having a bearing on the profits. And if there is no bearing on the profits of the entity, parent entity, which is issuing the corporate guarantee, it should not be treated as an international transaction. So coming back to the question, why is it that the HO is going to give a guarantee? The HO would typically should give a guarantee wherein the subsidiary does not have adequate financial standing, or it is inadequately capitalized. So in such cases, the HO would be issuing a corporate guarantee. But the intention is not to make profit or to generate any income out of it. It is just to support the operations of the subsidiary. If we go to the next slide, because this has been a subject matter of contention and has discussed in various decisions before the tribunal as well as the High Court. And surprisingly, there are diverging views which have been offered. So Ahmedabad ITAT in the case of Microing, wherein it was a case wherein the parent entity had issued corporate guarantees on behalf of its associated enterprise without charging any consideration. The ITAT has upheld the position that the guarantees were prima facie in the nature of a shareholder's activity. It was akin to a quasi shareholder function or quasi capital function. And the objective was to compensate for lack of or core strength of raising finances from the bank. Such issuance of corporate guarantee would not even tantamount to a provision of service, which is discussed in 92B as well. That, and it will not fall as part of part D of the explanation, because part D specifically deals with provision of services. Now, if we saw in the earlier definition as well, or the explanation which was introduced, guarantee form part of part C, which was capital financing. It does not form part of part D, which is dealing with provision of services. That's what the ITAT's view was, and they have concluded saying that CGs or corporate guarantees could not have been issued by an assessee in a normal parlance to any third party, and therefore issuance of corporate guarantee cannot be even said to be having any bearing on the profits of the enterprise. The Hyderabad ITAT in the case of Prolifix Corp has had a different view, wherein it was the same situation, an Indian parent entity having provided a corporate guarantee for an acquisition which was made by its subsidiary. There, the ITAT's view has been that because a guarantee has been provided, what it has done impliedly is it has increased the credit worthiness of the yield. And if in a situation wherein there is a default, the guarantor, which is the parent entity, will have to fulfill the liability. Therefore, there is a sort of an inherent risk when it comes to issuance of corporate guarantees. And there may not be an immediate impact on the profit and loss account, but the inherent risk still remains. In terms of providing services, the ITAT said that the parent entity is providing a service by way of increasing the credit worthiness of the subsidiary. Otherwise, the subsidiary would not have been in a position to obtain a loan. And that's where the tribunal concluded that this is an international transaction and benchmarking or ALP determination will be required in this case. The decision in the case of Prolifix Corp has interestingly been upheld by Madras High Court in the case of Reddington, India. And this was also upheld in a recent decision of Macrotech developers by Mumbai ITAT. Coming to the next question on the valuation. Interestingly, many court decisions, the ITAT as well as High Court, have upheld 0.5% of the loan amount as the arm's length price for issuance of corporate guarantee. Just the recent decision in the case of Macrotech, wherein ITAT accepted an ALP of 0.35%, which was determined by adopting the yield approach. Now, yield approach is basically where there is a differential interest rate when the loans are guaranteed and when the loans are not guaranteed. And of course, it was adjusted for tenor adjustments, etc. But 0.35 was something which the ITAT has accepted in this particular case. So that's, as regards the valuation goes. Apart from that, the transfer pricing provisions also have safe harbor rules. So so what are these safe harbor rules? Now, safe harbor rules are basically circumstances in which the tax authorities would accept the transfer price or the ALP declared, and that would be the end of story in terms of there would not be any litigation surrounding this. So the safe harbor rules which have been prescribed, they have prescribed a rate of 1% when a corporate guarantee has been issued to a wholly owned subsidiary. So that also can be a benchmark or at least a rate that needs to be kept in mind when commission or corporate guarantee commission is agreed between the parent and the subsidiary. Lastly, just to close the loop in terms of, Sunil, you can go to the next slide. In terms of situations wherein corporate guarantee is issued by a foreign parent to an Indian subsidiary or an Indian permanent establishment. So this is basically to do with withholding tax. And I know probably we will just diverge from the topic for a bit, but I'll just take a couple of minutes. Now, in this particular case, wherein guarantee commission is paid to an overseas HO, what is the withholding provision say on it, and what is the liability under 195 to withhold tax? So such cases, the courts have held that this is income which has been deemed to accrue or arise in India, and therefore withholding is required. However, so there was a case in the case of Lloyd's by Delhi ITAT, which said that there is no other income article which is prevalent under the India-Netherlands Treaty, and therefore the guarantee commission was not taxable in the hands of the parent entity. At the same time, wherein there are other income articles which are prevalent in tax treaties, say like India, UK, and it was a case of in Delhi ITAT has held that it will be taxed as other income, and therefore it will be taxed in India, because the other income article would state that income would be taxable as per the laws prevalent in the state. So that's on the withholding bit, which one needs to be mindful of. Lastly, just to conclude, in the interest of time, FEMA provisions, of course, there was a restriction, or rather, the approval route was specified, wherein the guarantee was to be issued to a second generation or a subsequent level step down subsidiary. This has also now been liberalized under the new ODI regime, and the approval requirement has been dispensed away. So that's it, probably from an income tax and a regulatory standpoint. Jigar, over to you, and you can conclude.
Yeah. So yes, Sunil, you can keep that slide open. Thanks, Sanket. I think we have good information now on the perspectives of valuation and how it is being looked by income tax or regulatory perspective. So, friends, what we spoke about the taxability and the conclusion slide, I'm not taking one by one, but basically what we're trying to drive is that you may be an assessee who believes that it is not providing a corporate guarantee is not a supply due to multiple reasons. For example, an actionable claim, or what we just spoke about is a shareholders function. It's not a activity bearing any profits, or it's not in course of furtherance of your business. So that's one piece of types of assessees who will be litigating on the supply or the taxability of the corporate guarantee itself. And hence, for you all, valuation is not relevant because the litigation is on the supply itself. But those people who believe that providing corporate guarantee is a taxable supply, and because of Schedule 1 and the related party definition, it is an activity liable to tax, liable to GST. There, obviously, we'll have to ensure that an arm's length principle is being followed, and the transfer pricing regulations or the income tax regulations are also being looked up, and we value the transactions appropriately. And more importantly, we document it as well. So, we saw a 0.35% accepted by the ITAT, 0.5% by Delhi, and then a safe harbor rule of 1%, which we are borrowing principles from other laws to value the transaction, because those are the only laws where corporate guarantee valuation is being discussed at length. So we can decide. In fact, one more angle would be that if it's let's say two domestic companies are providing corporate guarantee and receiving corporate guarantee, and they're related, then obviously Rule 28.2, provision to Rule 28.2 comes up help where the valuation mechanism will not trigger, because whatever you charge will be accepted. So even a nominal value to the corporate guarantee provided may be accepted or should be accepted by the department. So even that could be a relevant perspective on the valuation space. So what I would urge is decide on your taxability and decide on your valuation from GST perspective. Ensure it is aligned with your income tax, transfer pricing, and FEMA perspective, and take a concluding decisions from the rulings which are already available, and decide on the taxability and value accordingly. That's what we would bring in from the webinar perspective or the session perspective. I'll directly head to the Q&A. Also, if I'm not able to answer because of lack of time now, I'm seeing a lot of questions coming in. I hopefully we will be able to answer most of them. But if at all there is not possible because of the time constraints, or you have already you are also running out of time, please note down our email IDs and numbers, and we'll be happy to answer you all. Sanket and Sunil, we will I will shoot the questions to you all, or even I will answer wherever possible. So please unmute yourself and let's start wherever we can. So the first question I have is from I'm reading aloud, so friends, don't mind. I'm just reading the question. It may be not in the perfect grammatical way. Mr. Rama Rao has question. There are common directors and or common shareholders in company A and company B. Company B has given its immovable property for the loan availed by company B from a bank. Okay, sir, I don't understand the question. Okay, let me try. There are common directors and company B has given immovable property for the loan availed. Sir, so what you are basically saying that I'm hoping your question is whether this is taxable or not, and the answer to this is basically one company is giving another company not as a corporate guarantee. It's actually giving a collateral of immovable property for the other person, the bank, to provide the loan. So for taxability perspective, everything remains as is because the supply is happening. You are providing a collateral. So let's say even a corporate guarantee, sir, if at all one is providing to a bank, I would assume that the bank is going to see the assets, let's say a fixed deposit which they are having in their bank account, and would eventually put a lien on that FDs. The bank will not randomly agree to a corporate guarantee. There would be some relationship between the bank and the provider of the corporate guarantee for the bank to accept and give the loan to another subsidiary company. So the entire taxability will remain as is, even if it's a collateral of the immovable property and not only a corporate guarantee basis which the relations were there. The next point is coming. In case not a question, I have actually answered to elaborate the questions. I will skip this. Whether GST would be chargeable if a director gives a guarantee to bank on behalf of the company. Sunil, would you want to answer?
So this is an issue which is again a debatable issue, and it is we have certain judgments under service tax laws also. In service tax, again the tribunals have held that because there is no consideration in respect of this transaction, and thus the director is not liable. The interesting question comes in context of reverse charge also, because in respect of directors other than whole-time directors, the services are subject to GST under reverse charge. So whether the company per se is liable to pay GST on it or not. Again, from director's perspective, under GST, the same points which we have, in context of corporate guarantees, if we leave behind the corporate guarantee part, then the question still remains whether it's an actionable claim or not, etc., etc. Right? Because the parties are related, and same issue would come: how to value, what would be the actionable claim. So same more or less issues are there under GST, but as far as the service tax is concerned, the issues is more or less settled that because there is no consideration, tax cannot be levied on corporate guarantee given by a director to bank in respect of loan taken by a corporate. Yeah.
Thanks, Sunil. Again, this is the answer which we gave was for Mr. Rajiv Kumar. The next is from Chetan Kumar. How much percentage share of GST on corporate guarantee is of total tax revenue in India? Sunil, I'm definitely sure you want to answer this.
I don't know.
Yeah, sorry, Chetan, we don't know this. We have no clue, and I hope one fine day you will get an answer, and please enlighten us with
just wanted to highlight one point here. We have seen few show cause notices. What the authorities are doing, they are treating the entire guarantee amount as a consideration, right? So if we have extended, generally we extend an equivalent amount of guarantee to bank. So what they are saying the entire amount of guarantee is equivalent to value, and you have to pay GST on the entire value. We have few show cause notices like this also. So with this approach, there would be a good quantum to argue from department's end.
Well, I think it'll be a good to fight. I mean, we forget about taxability. We just jump on the entire valuation perspective. It'll be good fun to litigate on such Shupa's notice.
Yeah.
The next question is coming from 1 minute. Sorry, I'm just trying to name it. Yeah, Mr. Rajesh Sirsat. It says 100% guarantee given by mortgage of land with subsidiary to holding company. Whether GST is applicable? Yes, sir. The same thing I think what we talked about earlier.
Yes.
Second question is corporate guarantee given by holding on to subsidiary in foreign, whether it can be shared or said as export, or whether it will be an import of service. Sunil, why don't you help us in what is export and import in this case? I mean, you highlighted it, but if you can just answer quickly.
Jigar, I'm not sure. Corporate guarantee given by holding company.
Normal, the routine transaction holding company is giving to subsidiary in foreign. So an Indian holding company is giving to the foreign subsidiary.
So it would not literally it would not qualify as an export of service, because you would not be realizing any consideration in this case, provided if you have a guarantee commission in this case, it can be said to be a export of services. I've seen one question also. One of the participants is saying, can it be treated as an intermediary service? In my view, it would not be treated as intermediary services, because the Indian party, the Indian guarantor is not facilitating or engaging two parties to enter into contract. So primarily, it would not be an intermediary service. The place of supply would be governed by a general rule, and it would be outside India. So if you are receiving the consideration, then there is no issue. It would be export. If you are not receiving the consideration, the points which we have highlighted in our presentation would be relevant to argue or to take up appropriate position. And if there is a foreign holding company who has a subsidiary in India, who is providing the corporate guarantee to an Indian bank, then the question would come in respect of the subsidiary company, whether subsidiary company is importing these services or not. Again, the same litigation would come, whether it's a shareholder activity, actionable claim is not there. Same sort of argument would be there, right?
Super. Next is by Dinesh. What is the taxability of personal guarantee given by director of the company for security of the loans taken by company?
This we have discussed, Jigar, na?
You answered.
Yeah.
Next is by Ankur Agarwal. Our holding company provides corporate guarantee to bank on behalf of our subsidiary company. Should we need to deposit GST or should we wait?
Jigar, I think the best strategy, those who are not facing the litigation, correct me if I'm wrong also, I think we should go with the protest approach. If you have a strong belief that, you are not liable to pay, but still you want to get free from litigation, you can file a letter to the department by saying that, there are, these are the arguments on which I personally believe that the tax needs to be not be there. And you can approach the protest method. And there is one point people generally say that under GST there is no concept of protest because specific provisions are not there. To us, having a protest, paying the tax, a particular amount under protest is nothing but a constitutional right. So there is no need to have a separate provision under GST law. You can pay using a protest mechanism. Yeah.
Superb. I agree with you. Taking base as provision of open market value, can holding company charge minimal amount as consideration for corporate guarantee as subsidiary is eligible for ITC? Yes. That we spoke, nominal value is good.
What is the treatment? Okay.
Yeah, Sunil, go ahead.
Dinesh, what is the treatment of GST for corporate guarantee given by holding for subsidiary? I think this we discussed at length.
No problem. We have one more. Samir has mentioned in the bank guarantee in the continuation from pre-GST scenario and continuing in post-GST scenario, then whether there should be considered as the supply in whole value of or on the incremental value in post scenario. You understand this, Sunil?
Yeah. So there is one more question relating to the corporate guarantee, that is the time of supply. In the show cause notices which we have seen, department is demanding the GST amount for each year separately. So suppose we have extended a corporate guarantee of 1 crore, they are saying this would be applicable for each year. So you have to pay GST again and again every year, right? But it is a one-time activity. You have extended a guarantee. In our view, it's a one-time activity. You have extended a guarantee one time. So once you have given a guarantee on day one, you have, if you are saying that it's services, then you have done a performance. You have provided services. It is similar to insurance services. You take a policy today for a period of 1 year, right? There may be a spillover to next financial year, but the services which the insurance company has provided, it has provided today only, right? And there are good judgments available also. We have also a recent judgment of Delhi Tribunal relating to non-competing fees. We had a similar issue. The issue was that the authorities were saying the non-competing fees are provided for a period of 5 years. So the amount, the agreement that you have entered, it was under pre-GST regime, but you have to pay GST under GST regime also because it has a spillover effect under GST. There, the tribunals have held that since the services had already provided under service tax law, you cannot again demand the GST under the GST regime. So in this context, that the provisions relating to time of supply would come into picture, and you have to determine accordingly the liability. We have a transitional provisions also under the GST law, whereby the point of taxation is rising under the service tax law, then GST cannot be demanded. So that needs to be referred in order to determine the taxability under GST, right? What is the treatment under?
Next is what about Sunil? I will take the question, please.
Please.
Sanket, I think this is for you. What about withholding tax if corporate guarantee is given by Indian parent to Indian subsidiary?
So earlier, this would not have been so much of an issue wherein withholding provision would have been attracted, but because of this 194R provisions coming in, which are very widely worded, and because if there is any benefit or perquisite which accrues, withholding is required. So 194 provisions would need to be evaluated in such a case. The department can borrow the judgment which has been rendered in the case of Prolific, saying that there is an inherent benefit which is being received by the subsidiary. This is a possibility that one will need to deal with.
Okay. I think one more very relevant point is coming up, which I would like to highlight here. And thank you, Sunil Gupta ji, to highlight this back to us. His point is, as per RBI banking norms, bank should obtain undertaking from borrowing company as well as guarantors that no consideration, whether by way of commission, brokerage, etc., would be paid by the former or received by the latter, directly or indirectly, thereby guarantee should be without consideration. So this is one of the criteria for corporate guarantee without consideration for GST purpose.
Yeah.
So what we are highlighting, what Sunilji is highlighting here is that RBI takes an undertaking from both the parties that there will be no consideration, no brokerage, no commission chargeable or paid by you. And if such kind of undertaking is given, then obviously it will be without consideration. So Sunilji, the only point is, yes, you're right. In cases where such kind of undertakings are taken up, there will be no consideration for sure. But as we spoke, Schedule 1 says without consideration also becomes taxable. So for taxability, this provision will not help. But from the valuation perspective, this point will always be helpful, that if you want me to value, how can you take an undertaking that there will not be, charging anything or recovering anything? And in that scenario, value should be zero rated. In the worst case scenario, a nominal value XYZ could be allocated. So this could be a litigation point for sure, because FEMA or the RBI goes against the principles of the safe harbor rules, or 0.35 or 0.5% as per income tax. And obviously, GST is still very new to give a very judicial precedence on how to value under GST. But a complete valid point is what I would agree on. Yeah, Sunil, I just saw your message. Yes, RBI is restricting for charging. I'm not saying you to charge. What government is saying is you to pay GST. They are not asking you to charge the value. They are just saying that it's a taxable activity and pay GST as per the value, because it's a related part. So even in the Schedule 1, where there is no consideration between the two parties, they don't ask you to charge for the value. They ask you to pay GST only. So the invoice or the debit notes which are raised are only pertaining to GST amount. There will be no value attached on it. It is because it is forming part of Schedule 1. But I agree with your ground. That could be one of the grounds of litigation. What would be the SEC code for corporate guarantee? Okay. Sunil?
I'm not able to recall quickly, but there is a separate heading under, the tariff next to the rate notification. There is a called as assurance services. That is the most appropriate classification of the corporate guarantees if you are intending to pay the tax.
Super. I think this answered, right? Sanket, you answered about this. What about withholding if corporate guarantee is Indian to? Yeah. Okay. I think, yeah, we are good. There are a few questions which are repeated, so I'm avoiding to answer them. But in case there is anything which is not answered for any reasons, you have our email IDs and numbers. You can reach out to us. We are more than happy to pick up. Again, thank you all for attending our session. Sunil and Sanket, I wish thanks on your behalf as well to the participants for hearing us and giving patient hearing. And again, thank you, Taxmann, for giving us a platform to talk to the participants.